Are you looking to take your personal finances to the next level? Well, you're in the right place. Welcome to the Monday Money Tip Podcast, presented by I Was Broke, Now I'm Not, with your host, Joseph Sangl.
Well, welcome to episode number 41 of the Monday Money Tip Podcast. This is Joe Sangl. I'm fired up that you've joined us again for another episode. I'm joined by my co-host, Megan Hibbard. And as of the release of this podcast, your baby should be about a month old. It's hard to believe.
That is hard to
believe. So
believe.
we're pre-recording some episodes prior to Megan going out on maternity leave. We're super excited for their baby boy.
Yep.
And well wishes and all that.
Oh, thanks.
On the delivery of this precious little life. It's going to be awesome. Today, we're going to talk about something that this child brings to you, and that is tax benefits.
Woohoo!
And so we're going to talk about, tell everybody what our official title of this episode is.
Yes, so our official title is Tax Issues You Should Know. So, and our topic, obviously, is talking about tax issues, but specifically, if you don't know, today, the day this is releasing is Tax Day.
That's right, April 15th.
April 15th day. I think there are places that do, like, benefits for Tax Day. Like, you can get free things.
Yeah.
So you should look into that. Maybe free food somewhere.
Here's something to think about, too. This is something that is crazy to think about. But if you think about 33% of your money ends up being taxed at some level.
Yeah.
Whether it's federal taxes, state taxes, local income taxes, property taxes, sales tax, use tax, all the different taxes, right? Mm-hmm. About 33%. So think about this. The first 4 months of this year, all you did was work for taxes.
It's kind of depressing.
It is kind of depressing.
Not kind of. It's
so
very
in this
depressing.
very depressing episode of the Money Money Tip Podcast, we're going to tell you some tax issues you should know.
Yes.
I hope it'll be very helpful to you.
So our specific question today is, can you tell me the top 2 or 3 things I should pay attention to when it comes to taxes?
Yes.
So we're going to be talking about that.
Fun topic.
Yeah. But first, it's your favorite segment. Aren't you so excited?
Yes. Let's go.
Now it's time to get caught up with our current money events.
This portion of the Monday Money Tip Podcast is sponsored by I Was Broke, Now I'm Not. Utilize the Debt Freedom Date calculator to determine when you will be debt-free. It will provide vision for your future and fuel to power you towards financial freedom. So visit our website at iwbnin.com, click on Tools, and select Debt to find all the debt calculators. And the best part, all of our tools are free.
That's awesome. And so we're super excited about all those debt tools. That's great. And I think you should use them. And I encourage you to use them on a regular basis, especially his debt calculators, because it's very encouraging as you see yourself, that date approaching that you'll be debt free. It's a wonderful day. So today's topic for today's current money events section is, that was pretty bad actually, did not nail it, is about investing in the stock market. And I know I talk about this sometimes from time to time about where the stock market is and all that stuff. But today I wanted to talk about, in a current money event, I wanted to talk about historical growth of the stock market. I know a lot of people talk about it's really risky. Mm-hmm. Do you remember when you first started investing? Did it feel weird, or did you just do that because people had told you this is the thing to do?
A little of both, but it definitely felt it's scary. I think it's still a little bit scary, just because the market's so up and down all the time, and I'm like a huge saver. So for me, it's like, maybe I'll just hold on to that money, and then it won't go up and down, but then it won't go up.
Yeah,
is the problem.
It seems like it goes down way faster than it goes up. Isn't that true? So it's like the market, the stock market, and investing is kind of like people. We overreact.
Yeah.
And so whenever it goes sailing down, I'm like, overreact much? Question mark. And so I wanted to talk about the historical returns because I think if we understand history, then our current and our future can be better.
Yeah.
Is that a good quote?
That's a good quote.
Pretty good quote. But the compound annual growth rate is how we look at these things. And they call it like CAGR. It's a compounded annual growth rate. And it's the most specific measurement of how money has grown over a specific period of time. Compound annual growth rate. It's better than the average growth rate. Because averages, they do not necessarily reveal exactly what has happened with your money, but a compound annual growth rate, as it's calculated, does. And there's a really good calculator, and we'll have it in the show notes. But I wanted to talk about the historical returns of the S&P 500, the annual growth rate. So when you look at the compound annual growth rate, the annual growth rate of the last 10 years. So if you're watching this on YouTube, which we encourage you to check us out on YouTube, you can see it on the screen. I'm also going to share it number by number here, but I don't want you to get mired down in the numbers so much as I want you to recognize they're greatly different. So, for example, in 2008, the return on the market was minus 37.22%.
Yikes.
So that was a yikes year, lost over a third of the value. The next year, 2009, it went up 27.11. But watch this. That 27.11 is based on this new number. So think about this. If you were at 100 and the number dropped 37.22, you're now down to 62.78. And 27% increase on that is not equivalent to the 27% of the 37% decrease in the previous year. In fact, it has to go up almost 50% to catch back up to the 37% drop. It's a weird thing about math.
Yeah.
And so what I'm saying is 2010, it went up 14.87%. And it's even though it went up 27.11% in 2009, 14.87 in 2010, those added together are 41% increase. It still didn't catch up to the loss of 37%. It was only in 2011 when we got 2% it made even. 2012 was up 15.88. 2013 was crazy, 32.43. 2014, 13.81. 2015 was 1.31. 2016 was 11.93. 2017 was 21.94.
Wow.
Stimulated by the tax reform.
Yeah.
And 2018 said, whoops, no more, minus 4.42. So what I'm saying is, of these 11 years I've just listed, 2 years were negative, 2 years were like 1% and 2%, and then there was three of them around 13, 14, 15, and then there was a 21.94, 27.11, and 32.43. And here's the thing that I wanted to share with you is the compound annual growth rate from January 1, 2009 to December 31, 2018, the compound annual growth rate, including dividends, which is profits paid out to shareholders, was 13.15%. In other words, if it grew 13.15% evenly per year, that's what it nets out to be. And if you don't include dividends, so excluding dividends, it's 10.75%. And so a dollar over that 10-year period went to $3.44.
Wow.
Isn't that awesome? A dollar grew to $3.44. So what if you had $1,000? What if you had $10,000? What if you had $100,000? And so that was a good 10-year period. However, if you include the 10-year period prior to that, from January 1, 1999 to December 31, 2018, that compound annual growth rate is not double figures at all because it includes the decline of 2002 and 3. It includes the dot-com bust. It includes the recession of 2006, 7, 8, around 7, 8, and 9. And so the compound annual growth rate was actually only 5.59%, including dividends, and was 3.63% excluding dividends. And a dollar, watch this, in that entire 20-year period only grew to $2.97. So what's that saying? You could have left your money out of the market for 10 whole years and put it in 2009 and would have come out ahead at $3.44. So in a 10-year period, your money has grown more than it has grown in 20 years. Isn't that crazy?
That is crazy. So
this is something really important to pay attention to because you can't time the market. No one knows when it is. And frankly, 5.59% is better than 0%. And 13-point-something% is way better than 5%. But the bottom line that I wanted to share with this data is you can't predict when it's going to go way up or down. A lot of these gains were made in a single day. And so don't try to time the market. The key is start investing, invest consistently. A little bit all the time is always way better than a whole lot at one time and then never doing it again. Don't try to time the market. Keep investing and do it consistently and invest within the stock market and also outside of it like real estate or small business, and you'll come out way ahead. The cost of not investing, of course, is far worse than investing at all. So that's what I wanted to share in today's current money events section.
Awesome.
That's a lot of numbers.
It was a lot of numbers. Hopefully you're still with us after that. Okay, so for our success story today, it's a little bit different, but I really like this one because it's from one of our churches that we've served before. So it's from Rockbridge, and specifically, they have multiple campuses, right? Or just
Yeah,
the
they're
one?
based in, I think, Dalton, Georgia,
yeah.
but they have campuses all over North Georgia.
Yeah. So this one is from their Chatsworth campus in Georgia. And it's 7 families that were participating in our group study. So the I Was Broke Now I'm Not small group study. And they focused on glorifying God with their finances that he had given them. So that's pretty cool.
That's
that was
awesome.
their focus. Yep. So here are the numbers from the group saved $10,650. The debt paid off was $14,379.50. And 2 families became completely debt-free.
Wow.
So Sam from Rockbridge shared that with us. So that is really, really awesome.
That's amazing. And that's in 6 weeks' time.
Yep.
Think about that. So if they paid off $14,379 in 6 weeks, and we take that times, and make it 52 weeks, it says they're on track to pay off $125,000.
Wow.
If they keep up that same focused effort. So that's fantastic. We're celebrating with them. And listen, we want you guys who are listening to the podcast to be doing the same thing. We want you to be experiencing, financial improvement and advancement in your savings, in the elimination of debt with your investments. And that's why we have this podcast. So we celebrate with the Rockbridge Chatsworth group, all 7 families.
Yeah,
Get
and if you're interested in learning more about our group study that we have, it's a 6-session group study. We'll put a link in the show notes for that as well. You can do it with a small group. You can do it at your church, or we have online access. So you can do it individually too. So It's a great way to kind of knock out that debt, save money, and then maybe you could be sending us a story saying that your group saved $10,000 and paid off $14,000.
That's awesome.
So that'd be
Congratulations.
pretty cool. Yeah. All right. So just to remind everyone, our featured question today, we're talking about tax issues. And so the question is, can you tell me the top 2 or 3 things I should pay attention to when it comes to taxes? So, are you ready?
Yes, on this tax day.
On this tax day.
On this brutal day.
Okay, so the first one we have is W-2 employees, know your exemptions.
That's right. And so one of the things that is super important when you talk about the top 2 or 3 things you should know is you should know what exemptions you're claiming at your place of employment. So if you're a W-2 employee, when you first started employment there, and maybe sometime later, you named the number of exemptions you wanted withheld from your paycheck. And so usually people claim themselves, if they're married, their spouse, and then their kids. But did you know you can claim 0 exemptions or a bunch of exemptions? The whole key is that you want to make sure you don't end up in a position where you cannot pay your taxes on this glorious tax day, because then you get in trouble if you've claimed, 9 exemptions when there's only you. And then you owe all these taxes. The government frowns on the fact that you withheld that money and you had that money all year when it was owed to them. And so one of the things that I want to encourage every single person to do is, if you've been getting a huge tax refund and you would prefer to receive that money as part of every paycheck, maybe you're focused on saving money or paying off debt, and you'd rather have that money every month, you're living with a budget, you're managing your money well, I would encourage you to check out this great calculator. We're going to include it in the show notes. It's provided by this website called Paycheck City. And have you ever been to that website?
I haven't.
It's so fun. And what you can do is you can type in your pay, and you can type in your state. So it takes, and your county, if there's local taxes, and you can put in different exemptions, and it will tell you to the penny what your new paycheck would be at different exemptions. And I find that to be very valuable, because you can also use it if you're looking to change your contributions to your 401k, which would reduce your taxable income. It will tell you, hey, if I'm going to contribute $200 a month to my 401k, well, your pay is not going to go down $200 because part of your tax dollars go with it. And maybe you'll see that your pay only goes down $168, something like that. But you can see it to the penny. And so I encourage you to use this calculator and adjust it. So let's think about it this way. If you've been getting a tax refund of $5,000 a year, then that means you probably have been giving the government an extra $400 a month that you didn't need to. Does that make sense? 400 times 12, $4,800. It's close to $5,000. So you could adjust your exemptions until your take-home pay is an extra $400. Do you see it?
Yeah.
If you're saying, you know what, I still want to get a lump sum of that. I want to get about $2,500. That's what I want to target. Well, then you could say, you know what, I'm going to adjust it until it reduces at $200. That way you get $200 extra a month in your paycheck, and then you could still get that $2,500 tax refund around tax time, so that you're still looking forward to filing your taxes and incentivized to do that there in February. But we know most people that get a refund, this is old news for them. This is just news for next year. But if you owe, we all wait till it's April 15th.
Yeah.
And so make sure you know that. Know your exemptions and use that website there at Paycheck City. It's so much fun. And we've included a link in the email that we send out to announce the new episode is released. And it's also in the show notes wherever you've downloaded this podcast.
Yeah. Awesome. Okay. Number 2, 1099 contractor or self-employed, save for taxes.
Yes. So if you're a 1099 subcontractor or you're self-employed, you receive income. And the problem and the huge mistake that so many people make that I've done coaching for is they forget that when you're self-employed or you're a 1099 subcontractor, which is basically the same thing, that there is a doubling of your Social Security payment, that FICA. That when you're employed as a W-2 employee, 6.2% of your paycheck is withheld from your pay, right? Mm-hmm. But guess what the employer does? They have to contribute an additional 6.2% with it. The same thing is true for Medicare. 1.45% is withheld from your paycheck, and your employer matches it with another 1.45. So every month, 12.4% of your pay is sent on to the Social Security office for you in your name, and then 2.9% is forwarded for Medicare. That adds up to 15.3%. But in your paycheck, if you're a W-2 employee, you only saw the 6.2 and the 1.45, so 7.65%. Do you see what's happening here? So when you're now self-employed, guess who gets to do the matching?
You.
You do. And so automatically, 15.3% of your earned income is going to leave you. You can take it to the bank, 15.3%. So what happens is many of these people, they're starting a business, they got into the subcontractor work, and they kind of spent all the money because they thought it was their money because they're used to receiving W-2 income.
Right. And
then tax time rolls around and they're told the sad, not glad news that they owe.
A lot.
And it's a lot. And what a lot is different for me. It's different for you. It's different for every person listening to this podcast.
Yep.
But here's the common theme. They come in meeting with me and their eyes are this big and they're like, what do I do? And I'll tell them, number one, you owe. You have to pay it. Number two, you need to make sure that never happens again. So if you're a 1099er or a self-employed, here's my recommendation that you should know. Automatically, when you receive income, put $1 out of every $4 away. Just put it in a tax accrual account. That way, you can absolutely, for sure, cover all the Social Security and Medicare, federal, state, and local taxes that you're going to be owed. In fact, if you save $1 out of $4, it's a really good shot that come around tax time, there'll be a little extra money left in that tax accrual account, and it will feel a little bit about getting it like getting a tax refund. So I really encourage you, save. You will never regret it, and you will avoid a lot of financial pressure and stress that is unnecessary.
Awesome. All right,
Hey, I want to share one other thing.
Oh, yeah.
Estimated quarterly tax payments can really help with this. And when you work with a professional tax preparer, a lot of times they'll set you up with quarterly estimated payments. So in January, April, July, and October, you can make an estimated payment, and that makes sure that money leaves your life so you're not tempted to spend it. So just wanted to share that as one more tip.
Yep. All right, number 3, utilize available tax incentives and advantages.
Yes. And so many of us, whether we're a 1099er, self-employed, or W-2 employee, we're not taking advantage of all the tax advantage stuff that's available to us. One of the ones that I see all the time that drives me crazy is most states offer a property tax reduction for your primary residence. And you usually, for some reason, have to apply for that. Most real estate agents who are good make sure they remind people when they're buying their new primary residence to apply for that reduction. However, many people, the busyness of life, of course, they're moving, they forget to apply for it. And they don't realize that they're overpaying. And in general, that could reduce your property taxes in many states by a third or more.
Oh.
And so this could literally mean thousands of dollars. So make sure that you're getting the property tax reduction on your primary residence. And if you're inheriting a home, there's something called a homestead exemption. And you want to understand that so that you're not taxed unnecessarily or unduly and unfairly, I might add, if you've inherited a home. So make sure you look up the words homestead exemption and property tax reduction on a primary residence. Another great tax advantage available to many is to contribute to an IRA. In 2019, it's been increased for the first time in about 4 years. You can now contribute $6,000 to a regular IRA or Roth IRA, as long as you have at least $6,000 of earned income. If you have a non-income producing spouse, they can also contribute up to $6,000 to our IRA or Roth IRA. If you're over the age of 50, welcome to ARP. I'm about to get there, 5 years. But here's what I want you to know. You can contribute an extra $1,000, which means so-called catch-up contributions.
Woo!
$7,000 a year. And that's a lot of money. And I know many of you are like, $7,000 or $6,000. I'm lucky to do 1,000. Well, then do 1,000.
Yeah.
Because you can deduct a regular IRA contribution from your taxes, and that can help reduce your expenses. And by the way, you have all the way up till April 15th of the following year to contribute to the previous year's plan. So that's a huge thing to think about when it comes to tax advantages. Plus, it incentivizes right behavior, which is investing for retirement. So the next one is a home office. So you work at your house enough, that might be a home office at some level.
I know our home office got converted to a nursery. So
there's gonna be work.
I need to find a new a lot of times I work at the kitchen table.
Okay.
But I need to find a new space. So we're thinking about maybe turning the guest bedroom into half guest bedroom, half home office.
There we go.
So that we could still have a space.
Is Barkley allowed in the nursery?
Yeah, he is. He loves it in there. So we have this rug in the middle that he loves laying on, and he found a spot behind or beside. We have a rocking chair in there, and he loves to sit. Jordan and I just go in there and sit all the time. And he loves to sit right beside it. But he doesn't shed. And so for me, it doesn't really,
Is that a lie?
That he doesn't shed?
He doesn't shed at all?
No, he doesn't shed at all.
For real?
Yeah.
That's amazing. What type of dog is he again?
He's a sheepadoodle.
He's a sheepadoodle. I love hearing that. That's awesome. And he's from Phoenix.
He's
somewhere
from
near
Phoenix,
there.
Arizona.
Yeah, it's awesome. He's a desert dog. He's awesome. But anyhow, if you work out of your home office and it qualifies as the definition of a home office, you can potentially write off a portion of your housing expenses. And that can be a very, very good way to reduce your taxes.
Yeah.
Ultimately, what I want to encourage each person to do is to at least, even if you farm out your taxes to a tax professional, to at least work through the tax form yourself before you take it to your tax professional. It will help you understand how the tax code works, and it will make you want to vote every single Tuesday, not just voting day, because it helps you understand, hey, there's a lot of money being taken out of my income, and it makes you say, I want to become an informed citizen to make sure that these dollars are being utilized in a way that I feel like advances our city, our county, our state, and our country. And so make sure you do that. And it will also help you understand when there's a lot of questions saying, does this apply to you? Does this apply to you? Does this apply to you? It'll help you understand, hey, this could apply to me in the future, and it might give you an opportunity to take advantage of a tax advantage in the future.
Awesome. Okay, so we have a few helpful tools. You've already mentioned one of them. So the W-4 Assistant, that's the paycheckcity.com, and we will have a link to that in the show notes, so you guys can just click on that. And then this next one, you talked about in the beginning of the current events, this calculator. Do you want to just refresh?
Yeah. So the other tool that I wanted to offer today is from the current money events section. Nailed it that time. The compound annual growth rate calculator. And you yourself can go use this calculator and look at the different rates of return over any period of time of the market that you want to choose. Choose it with and without dividends and that sort of thing. And for all you numbers and nerds out there like me who likes to look at that stuff, it's a lot of fun to just play around with those numbers. Fantastic.
Okay. And our key financial quote for today is the only difference between death and taxes is that death doesn't get worse every time Congress meets.
Is that a pretty good quote?
Will Rogers.
Will Rogers. Isn't that so good? I'm going to say it. It made me chuckle. The only difference between death and taxes is that death doesn't get worse every time Congress meets. And, Congress, man, they do not have an enviable task.
No.
I mean, our nation was created as an experiment, and it is a messy experiment at times, looking at the different sides of the aisles. But here's what I know. Taxes are convoluted, and they're crazy, and they're confusing. And this is a topic that affects you and I and everybody who's listening's money every single time they earn some. And so I want to make sure you become an informed taxpayer so that you can vote appropriately and make sure that what you're passionate about, what you value, you get to have your voice heard about.
Perfect. Okay, so for our next episode, we're going to be talking about spring cleaning your money. Get excited about that.
Yes, it's springtime.
I love it.
So I felt like it'd be a really good episode to talk about spring cleaning your money.
Yeah. So April is a time when many people clean out their houses and do all their spring cleaning, which I'm sure I've already been doing that, but I'm sure I'll be doing it more.
Oh, yeah.
And we'll be taking some time next week on our next episode to discuss how you can spring clean your finances.
Awesome.
So get excited about that. And if you like today's episode, please help us get the podcast to others who could benefit. You can do this by quickly rating our podcast and leaving us a review. These ratings and reviews help us to make our podcast better. And make sure you hit subscribe. Make sure, if you like what you're listening to, just hit the subscribe button, and each week it will just come to you automatically, and then you can listen to it on Monday on your way to work or when you're spring cleaning your house. Who knows? And then don't forget, on the last Monday of the month, we're going to be talking about your top money questions. So if you have any of those, please email them to us. And you can send those at info@iwbnin.com. And it could be featured on the podcast.
Yeah, and I want to say, any question, any money question on any topic. So make sure you ask them. We love to do that in a couple weeks. The next podcast, April 29th. In a couple weeks, will be all about the questions that have been asked by our listeners. We're excited to hear from you.
Yeah, I really like those episodes.
Yeah,
I think they're fun.
Because they're kind of wide-ranging, lots of different topics.
And then if you implemented one of our tips or you have a success story, we'd love to hear those as well. So make sure you send us an email, and you could be featured on the podcast. So exciting times.
Awesome. I'll finish this tax-paying episode with a statement. I love paying taxes, for it means we've made profit. You should celebrate too. Get fired up.
Thanks so much for listening to this episode of the Monday Money Tip Podcast, presented by I Was Broke, Now I'm Not. If you enjoyed today's episode, please leave a review and subscribe. And for more great content and to stay up to date, visit iwbnin.com. We'll catch you next time.